In our headliner now, Keith Banks, Vice Chairman at Bank of America, the Chief Investment Officer of Pension and Benefit Plan Investments. It's a big title because he's a big guy. Welcome back. It's good to see you.
Good to be here, Scott. Thank you.
Important jobs you have. How do you see the market? I haven't seen you in a while. And look, if I would have asked you this a month ago, I don't know what your answer would be, but maybe it's different today given the comeback we've had.
Well, we're first of all, great discussion with you and the investment committee. So I enjoyed listening to the to and fro.
What do you agree with?
We're more in the more in the range bound camp. So we've been using a range of 4,000 to 4,700 for the S&P, and we think that's still the right way to think about it. There's a couple of problems that I think the equity markets have in terms of breaking out above that. Number one, if you even assume the more optimistic view of earnings for this year and next year. So take 225 for this year, add 5% for next year, plus get to 235. It still leaves you with a PE multiple, north of 20 times. That's a very healthy PE multiple when you have rates going up to the degree to which we think they're going to go up, and I'll share that with you in a moment, as well as inflation. So, I think there's a natural limit. Our view on the Fed side, we do believe the Fed is playing catch up. I think they believe they're playing catch up. So we think in May you're going to get 25 basis points plus the announcement of quantitative tightening. And then beyond that, in June and July, 50 basis points. And by May of 2023, we think you're going to see the Fed funds rate between 3 and 3.25. There's a very tricky trifecta for equities. When you have any one of these things that the markets can deal with, but if you get decelerating earnings and rising rates and rising inflation, historically that's been very challenging for equities. So given all that, that's why we've been staying in this range-bound 4,000 to 4,700.
In other words, if you think the Fed's going to be as aggressive as advertised.
We do. We think there's, and Steve may have made the point before, but I think right now they're concerned about credibility. I think they want to show the markets that they are going to be out there. They're going to do, they're kind of in the we'll do whatever it takes mode, or it felt that way after the recent testimony by Chair Powell, as well as some of the Fed presidents that spoke afterwards. So I think that's important. I do think the resilience of the markets and the resilience of the economy gives them even more confidence to pursue the path they believe is appropriate at this point. And that's the one I just laid out for you.